One of the biggest advantages in real estate investing has almost nothing to do with finding great tenants or picking the perfect property. Nope, it actually comes straight from the tax code, from a concept called depreciation. And it's how a ton of investors make serious money while legally paying way less in taxes. So think about this for a second. What if you made $20,000 in pure cash profit, but when Uncle Sam came knocking, he only saw about a quarter of that as income you actually have to pay tax on? Sounds a little too good to be true, right?
Well, believe it or not, it's not some crazy fantasy, and it's definitely not a shady loophole. It is a core part of the tax code that's available to every single real estate investor. It's an incredibly powerful tool called depreciation, and today we're going to break down exactly how it works.
Okay, here's how we're going to tackle this. First, we'll get into what depreciation actually is. Then, we'll run through a super simple real-world example. After that, we'll see the real power of what I call paper losses, and finally, we'll see how this stacks up against your typical W-2 job income. All right, so let's start with the absolute fundamentals. What is this thing that kind of seems like it creates a tax break out of thin air? Well, it all starts with a very simple real-world idea. Buildings just don't last forever. So the official IRS definition says depreciation is a tax deduction that lets property owners recover the cost of a building over time. The government basically looks at it and says, hey, we know your building is getting older. The roof is aging, the foundation is settling, it's wearing out. So they let you deduct a little piece of that building's cost every single year as an expense. And for residential real estate, we're talking houses, duplexes, apartment buildings, the IRS has a magic number, 27.5 years. This number is the key. It's the foundation for all the calculations that make this so powerful. And this right here is an absolutely crucial distinction. You can only depreciate the building itself, the structure, the roof, the walls. Why? Well, because those things physically get old and wear out. The land underneath it, though, the IRS considers that a permanent asset. It doesn't really wear out. So when we do the math, we have to split the value of the land from the value of the building. Only the building part gets this sweet tax benefit. Okay, enough of the theory. Let's make this real. Abstract ideas are fine, but seeing the actual numbers is what's going to make this whole thing click for you. So imagine you buy a rental property for $500,000. After you get an appraisal, you figure out the land is worth about $100,000. That means the building itself is worth the other $400,000. And that $400,000, that's our number. That's what we get to depreciate. Now, the math here is so simple. You just take the value of the building, our $400,000, and you divide it by that magic number we just learned, 27.5 years. That's it. That's the whole formula. And what you get is about $14,545. This is your annual depreciation deduction. I like to call it a paper expense. And here's why that's so important. This is an expense that only exists on paper for tax purposes. No cash actually leaves your pocket. You don't write a check for this. It's just the IRS letting you claim the building's aging process as an expense against your income. Okay, so you've got this $14,545 paper expense. Now for the fun part. How does this actually save you real money? This is where the power is really unlocked. Let's keep our example going. So, after you collect all the rent and you pay all the real bills, the mortgage, insurance, repairs, all that stuff, you're left with $20,000 in actual cash profit for the year. That's money in your bank account. Now, check this out. You start with your $20,000 in real cash profit. Then, you subtract that $14,545 paper expense from depreciation. And just like that, your taxable income plummets all the way down to just over $5,000. I mean, the difference is just staggering when you see it like this. So let's let that sink in. You earned $20,000 in real spendable cash. But from a tax perspective, you only have to tell the IRS you made about $5,500. You pay tax on the small number, not the big one. This right here is the absolute heart of real estate's tax efficiency. Now, to really truly get how amazing this is, we've got to compare it to how most people make a living. A regular job where you get a W-2. And believe me, the way they're taxed are like night and day. This table really says it all. It's like two different worlds. On one side, you've got a W-2 job where you get taxed on your gross pay right off the top with very few ways to lower it. But on the other side, with real estate, you're taxed on your profit and only after you've subtracted a whole bunch of awesome deductions, with depreciation usually being the biggest one of them all. And don't forget, depreciation isn't working all by itself. As an investor, you're already deducting all your real cash expenses. Property taxes, insurance, maintenance, the interest on your loan. Depreciation is then layered right on top of all of that, sheltering even more of your cash flow from taxes. It's like a deduction on top of your deductions.
So the bottom line of all this is pretty simple, but it's profound. This system allows you to keep way more of the money your assets are making. And that means you can reinvest it, you can buy more properties, and you can build wealth so much more efficiently than if every single dollar was being taxed like regular income. So now that you're in on the secret of how this paper expense creates a very real tax shield, how does it change the way you think about making money? It kind of forces you to realize that it's not just about what you earn, it's about what you keep. Sure, there are things to consider down the road, like something called depreciation recapture when you sell, but understanding this one single concept is the first major step to unlocking a smarter, more efficient way to build wealth. Depreciation isn't a loophole, it's a powerful tool, and now you know exactly how it works.
Before you go, one quick thing. If you found this video helpful, please consider subscribing to our channel. We're building a community of people who want to think differently about money, investing, and financial freedom.